we are looking at business combination in stages. All right. Another name for it is piecemeal acquisition. So we have step by step. And the rule for IFRS 3. Sorry, I take taxation a lot too, more than I take CRSF. So that's why I mentioned FIRS more than IFRS. But yes, we are on IFRS 3 here. So the key rules for IFRS 3 is that control is what triggers consolidation, right? Not just ownership percentage. Right? So you can own a company and not have control over that company. And control is simply used for when you can restrict another person from using it. Okay? When you have power to restrict another person from using that particular thing, then that is control. Do you understand, please? So that is control. Now, this control we are talking about, when control is achieved in a step acquisition, the investor must remeasure the previously held interest to fair value. Hello, are we together?
Yes, sir.
So we must measure the previously held interest. What percentage were we holding in the past? That percentage, we must measure it. Okay? Now, after measuring the previously held interest, you measure it at the fair value this time around. Okay? Then the next is that you recognize any gain or loss in P&L or OCI, other comprehensive income, depending on classification. Do you understand, please? So we measure our gain and loss in P&L account. Then also goodwill is calculated using the total consideration, that is fair value of the new plus the remeasured old investment, fair value of the two investments plus NCI minus net assets of subsidiary. Please, are we together? Are we together, please?
Yes, yes, Mr. Kasim, yes.
Okay.
Please go again. Go again, please.
Is let me confirm my settings here. Okay. So now, purchase of addition or additional shares after control. All right. So after you have your control, your purchase of additional shares, how do we treat it? Now, if it is an additional share, then it's not a business combination anymore. This time around, it is you buying additional share. You're already a shareholder. You already have control. You're not just applying for the control, you already have control, right? So for your additional share, it is not a business combination. Okay? For your additional share, it is not a business combination. Instead, it is a transaction with equity holders, right? So that is it. Now, what do we have to do when we have this? When we have a transaction with our equity shareholders, that is, we bought more shares after control has been gotten, after we have control over the financial statement of the company. Now we have additional shares. So what we have to do is that we need to look at the difference between the consideration paid and the change in our NCI. The consideration we paid and the change in our NCI. Are you there? Now, the next thing you have to look at is that this NCI and the consideration you have paid, you're looking at them, you're recognizing them directly in equity, not in P&L account or goodwill. You understand? Now, you also need to calculate the reduction in NCI, because if you have 70% shares in a company before and now you have 80%, your NCI has reduced from 30 to 20, right? So you need to calculate your NCI reduction based on the percentage of that reduction. All right, and then you multiply by net assets at that date, at the date of the new one. The second one is equity adjustment. Your equity also has changed, right? So you look at the consideration you have paid, you deduct it from the reduction in the NCI. Do you understand?
Please come again with this equity adjustment.
So for equity adjustment, we are saying that you are to adjust what you have in your equity, considering what you paid as the consideration. All right, purchase consideration, the amount you have paid to acquire that new equity, less your reduction in NCI. Is that okay, sir?
Yes, sir. For me, sir.
Now for NCI measurement, to measure our NCI policy, okay, so now you can use a policy of proportionate share and you can use your fair value at the date of acquisition. So for the proportionate share, that's where you have your NCI to be the percentage of the net asset, right? The proportionate share is NCI will be percentage of net asset, while your own will be percentage of net asset as well. Okay, so that's it. Now, for fair value acquisition, that one is to adjust by share of post acquisition profit and changes in the NCI. Okay, so all these things we are saying we will apply them when we get to our calculation question. Then also
Mr.
I
Kasim.
need to let us be aware that
Mr. Kasim.
we really need to be coming to
Please,
class.
please, please, can you backtrack?
Okay,
Just the last piece of information you gave.
so here we're talking about the NCI measurement policy, and we have two policies for NCI. It can be the same proportionate share of assets, of the net assets, or the fair value acquisition, the fair value acquired. So for the proportionate of net assets, you have to say that your NCI will be the percentage of the net asset, right? While the fair value is to adjust by share of post acquisition profit and the difference or the changes in the NCI. Is that okay?
Yeah.
Mr.
Okay.
Kasim, please, one question, please.
Go ahead, sir.
Sir, this proportionate share and the fair value at acquisition, is it the same method as valuation of our NCI and the previous calculations that we did?
Normal consolidation.
Okay, okay.
Yes.
So this fair value, please, I want to take clarity on something, please. This fair value, we want to, when we are doing our goodwill, when we are getting our goodwill. Now, is it the same as fair value at acquisition date? The acquisition reserves that we use in calculating goodwill, is it the same method? Then once we calculate NCI, then we now say percentage of NCI percentage of NCI times total net assets. Is it the same thing, or is it the one that relates to proportionate share, please? I want to seek clarification on that, please.
So what you are saying is also what we have here, and it's on the screen here as well. Our NCI is the percentage of net asset. If you are using
Okay.
proportionate share,
Okay.
right? And if it is the
Okay.
fair
Oh.
value, it
Oh.
means the fair value of that asset
Oh.
will be given to us.
You give it to us. Okay. Yes. Sir. Thank you, sir.
All right. Now, so for instance, now we have a simple illustration here where we have initial acquisition of 60% at 540 million. All right. Then we now reacquire 150 million, right? Or sorry, no, this RA. What is our RA now? Eh?
Retain any? Is it
Retain
retain
earning.
any?
Thank you. So our retain earning at acquisition is 150 million. Okay, at the date of acquisition. Then second purchase is at 10%, right? Where the retained earning is at 300 million. Are you there, sir? I hope all of us are there.
Please hold on. Don't scroll. Yes, please.
I don't understand.
Write the illustration that you print. The scenario.
What are you saying? I didn't get your question. I didn't get what you're saying.
No, I said.
The network is bad, though.
I mean the illustration, the scenario you printed up. This example that you were using.
Yes.
I said I want to get it down. I want to write it down.
Okay, you want to write it down.
Yes. Yes.
Okay, so I can do a screenshot for you so that we don't have to wait. Although we are still there, we are still in that page.
So I'll screenshot. I'll screenshot.
Okay, please. So now, the step-by-step calculation will now be that for the parent share of the post-acquisition retained earnings, there is an increase between the second purchase and the first purchase, right? So the retained earning as at the second purchase was 300 million, as at the first purchase it was at 150 million, which means there is a percentage of 50% increase, right? Is it 50 or 100%? That is 100% increase. So 100% increase, that is, the difference is 300 million minus 150 million. The deal was 150 million increase in the retained earning, right? Am I right? 150 million
Yes.
increase in the retained earning, right? So these are retained earning. Sorry, that person has been added. Okay, so for the retained earning now, what is the percentage of what have we acquired? The percentage of the parent company, the parent shareholding. At first, it was at 60%, right? Am I right?
Yes.
So that 60% is the increase. Oh, so 60%, 60% was the initial acquisition. So now it means that the parent is already part of the business, which means out of this 150 million increase, the parent already has 60% of it because they were part of the business as at that time. Am I right?
Yes.
Am I right, please? Hello?
Hello, Mr. Kazim.
Are we together, please?
I'm with you.
Now, let's say that at the date of consolidation, at the time of consolidation, all right, don't forget the net asset, the retained earning at the date of second purchase is what we are still doing now. The retained earning at the date of second purchase has increased to 300 million. So that increase, the parent company was part of the parent company has also been part of the business up to that date of purchase, right? So the excess of that 150 million, the parent company is entitled to 60% of it, right? Now, let's say After a year, which is at the date of consolidation or at the reporting date, don't forget we always have retained earning at the date of acquisition and at the date of consolidation. So we are saying that, let's say at the date of consolidation, the retained earning has increased to 400 million. That is from 400, I mean from 300 million to 400 million. That is an additional 100 million. Am I right? From the date of acquisition to the date of consolidation, the retained earning has gone to 400 million. All right. So which means on that 400 million, don't forget we have already taken our post acquisition, I mean pre acquisition profit. We share the pre acquisition retained earnings between the parent company and the NCI. Right now, from that 300 million to the end of the account, which is additional 100 million, that is 100 million that has been made. All right. So for that 100 million now, the parent company still has 60% initial acquisition and 10% additional acquisition. I don't know if that makes any sense.
Please come again, sir.
From the okay, I said from the date of acquisition, the profit, the retained earning of the company is 300 million. Right? From that 300 million, since there
Mr.
is,
Kasim,
please be
that
quiet.
300 million was
Yes,
our
second
second purchase,
acquisition.
Abi.
Yes, at the date of second purchase,
Okay.
we have 300 million. Now, it's just like, let me give you an example. Let me use something else. Let me use partnership business. For those of us who can remember partnership business, I know you didn't do partnership business in your FR, but you have it in taxation, right? For those of you who did skills level and you have partnership business in taxation. Now, in partnership business, when a new partner is coming in, what do we do?
We revalue goodwill.
Is it only the goodwill?
We can do revaluation of assets.
So what happens is this: when you have a new company, is someone trying to come in? When you have a new partner coming in, the first thing you have to do is to seize that partnership business and share everything in the partnership business. And that's why the introduction of admission of a new partner or the retirement of a new partner automatically brings the partnership business to cessation. Cessation rule applies. I don't know if you can remember that. And
Yes.
that is what we are trying to do here. Now, this 10% is like an additional or a new partner coming into the business. Before that new partner comes in, please let us share what we have. Normally, is that not what is meant to be? Two of us are into partnership business. Someone else is coming to join us. The profit we have on ground, are we not supposed to share it? Do you understand the point now? So
Yes,
that
to
is
that
the
extent, I
first thing
understand.
we have to do here. The first thing is that we have to share the profit on ground, which is the acquisition, I mean, the retained earning we have before that new 10% joins us. Forget about the 10% coming from the same parent company. Forget about that. In actual sense, the money we have, the retained earning we have before that 10% joins us, let us share it. Does that make a sense? Does it make any sense, please? I need you to unmute yourself.
Mr. Kasim, come again with the last statement, please.
Okay. So what I'm saying is this.
And also, sir, the link will end in the next 14 minutes. I don't
Yeah,
know
I
if we
know.
can get
It's
another
fine.
link.
Let it end. Once it ends, we'll send another link. Now, what I'm saying is this. Mr. Ismail, me and you, we are in a partnership business. Right? Now, Mr. Boala wants to join us. If Mr. Boala wants to join us, does it make sense that the profit me and you have made before you joined us, we should first share that profit between me and you? Does it make any sense?
Yes.
It makes a sense, right?
Yes.
Now, Mr. Bola, that's that means that profit we have is the retained earning before Mr. Bola comes in. Now, Mr. Bola is the 10% additional share. Does that make any sense now? So at the date
Yes,
where
yes.
Mr. Bola wants to come in, we have made you and I, we've made 150 million naira additional profit. Can two of us share that profit before Mr. Bola comes in? Does it make a sense for us to share it before he comes in?
Yeah, sure.
Yeah. So that is the first money we said we want to share as this 150 million. So from that 150 million now, you have 60% of this our partnership business. You already have 60%. So out of the 150 million, you are entitled to 60% of the 150 million, which is 90 million. Does that make a sense?
Yes.
Does it make a sense, sir?
Yes, sir.
Okay, now after Mr. Bola joins, when Mr. Bola joined us, how much was our retained earning? 300 million, right? Am I right? 300 million was the total retained earnings. Am I right?
Yes. That's as the second purchase of
Yes,
that
now
10%.
second purchase.
Yes.
I said it that Mr. Bola is the second purchase now. Is the one purchasing the second one. So when
Okay.
I mention Mr. Bola, we are talking of second purchase, of course,
Okay.
right? Now, when
Yes,
Mr.
sir.
Bola wanted to join us, we already had 300 million as our retained earnings, right? Am I right?
Yes, sir.
Yes,
Yes,
sir.
sir.
Now, after he joined, we made additional 100 million and our retained earning came up to 400 million.
Okay.
So where's the 100 million coming from?
That's what I'm saying now. I said Mr. Bola joined at the beginning of the year. He joined on the 1st of January 2024.
Mm,
At the end of the
yes.
year, our retained earning has gone up to 400 million. Where is that retained earning coming from? If I am to ask
Sorry,
any one of
is
us.
that hypothetical or is it
Sorry?
inconsistent? Is that hypothetical or does he agree with the question you're solving?
It's agreeing with the question we are solving.
No, Mr. Kazim, I think what Mr. GTB is trying to say is, from the initial illustration, where after that second purchase, there's no introduction of 100 million. There's no additional 100 million increase in the retained earning. It
There
was
is what?
it was at the end of the year that we now assume that okay, this is increasing by 100 million to make it 400 million. I think that's
Okay.
what Mr. GTB is pointing to.
Okay, so this is it. At the date of acquisition was at the beginning of the accounting period. When he joined
Mhm.
us, we had 300 million retained earnings.
Yes.
Now, at the end of the accounting period, which is after 1 year,
Mhm.
our retained earning increased to 400 million. So do you know where the 100 million is coming from now?
Can you have a look at the question again? Because there's no 400 million in the question.
Okay.
No, Mr. GTB, if you
Don't
check
worry,
at,
I'm
if
coming, I'm
you,
coming. Let me look at the
okay,
person
sir.
who wants to join. I thought someone wanted to join. Okay. So now, this is what we are. Can you see my screen, sir?
Yes.
Okay. Can you see this place? From second purchase to reporting date. Can you see it, sir?
Mm. Yes.
Assuming the retained earning has increased to what?
That was my question. Now I said, is it hypothetical or is it from the question you're solving? So
Now,
if
this
it's an
is just an
assumption,
example. There is no
okay,
formal question here.
okay,
This is not a pathfinder question or something. We are just trying to
okay,
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 we are hypothetical.
okay,
We are just bringing a
okay, yeah,
scenario to explain this step-by-step purchase.
yeah,
We are
we're on the
saying
same
that
page.
assuming that the revenue, the retained earning has increased to 400 million.
Mm.
That means we have made additional 100 million, right?
Yes.
Now that 100 million, how much is Mr. Bola sharing from the 100 million? Mr. Bola
To
has how
share
many
100 million.
percentage? Mr. Bola came
Okay.
in with how many percentage?
10%.
10%. So which means from the 100 million, only from the 100 million is what Mr. Bola is taking 10% from. Yes.
Yes.
Then you, Mr. What's your name again? Sorry, I have to check the name. Mr. Ismail. You, Mr. Ismail, you still have 60%.
Yes.
You will take 60% of that 100 million, right?
Yes. Yes.
While me, I'll take the remaining 30%.
Yeah.
Does that make a sense now?
Yeah, it does.
Let me see that percentage. This account is making noise. Okay, better now. So that is what we are saying here. So which means the total parent company, you, Mr. Boala, your total post-acquisition profit from the first acquisition, your total post-acquisition profit will now be the first 90 million you cashed out, right? Before the second acquisition, right? Am I right
Yes,
here?
sir.
Yes, sir.
Yes, sir.
Plus the 10 million you cashed out as in after the second acquisition, at the reporting date after the second purchase, right? Do you understand that, sir?
Yes,
So
sir.
where is the 10% coming from? Why did we move from 60% to 10% for parents?
Okay, we said there was a second purchase by the parent. The parent purchased another 10%, and I used Mr.
Okay.
Boala as
Okay.
that
Okay.
10%. That Mr. Boala is
Yeah.
that second purchase.
Noted.
So
It's
which
clear.
means Mr. Ismail will be taking the 90 million he initially got before Mr. Boala joined, and also the 10 million Mr. Boala collected on this 100 million additional profits, right? Am I right, please?
Yes.
So that is it.
Which
Don't forget,
means
of that same
is
100
is
million,
denominated by the percentage acquisition. That's the
sorry,
second acquisition percentage.
I didn't get that.
That means the basis for determination of his additional return earning is the percentage of shares acquired
Yes,
additionally.
the additional percentage acquired. Shall we proceed now? Shall we proceed, please?
Yes, sir.
Okay. So now, for your equity adjustment on that additional 10% purchase, is that now, before you purchased additional 10%, at the date of purchase, NCI was at 40%, right? Because Mr. Ismail has 60. So NCI was at 40, right?
Yes, sir.
Now, this NCI has reduced to 30% because Mr. Ismail has purchased additional 10%. Am I right? So the
Yes, sir.
Very
10%
clear.
at this
Very
date,
clear.
at the date of acquisition, will now be the share capital plus the retained earning. And what's this? We are saying that the 100 million naira plus the 400 million is the retained earnings, right? Am I right?
Yes, sir.
The total retained
Yes.
earnings of the business is now 400 million, starting from the first acquisition.
Yes,
Is it
sir.
starting from the first acquisition or starting from the from the outset, from the beginning of that investment, starting with the 150 million naira we met in the business before we joined? We met 150 million in the business before we joined, but right now the business has 400 million, right? Am I right?
Yes, sir.
So now from that 400 million, which is the retained earning, 10% of it is the share of post-acquisition of that after that 10% additional purchase, right? And the purchase consideration was 45 million. Am I right? So which means
Yes.
the adjustment now is that we made 400 million as the retained earnings. Why there was a consideration, we paid 45 million naira for shares. and the retained earning is 400 million. I mean, 40 million, sorry, 10% of the 400 million, right? So the adjustment for that 10% is 40 million, right, which is the retained earnings, and 45 million as the purchase consideration paid for the shares. Do we understand? This is just an illustration, hypothetically. Okay? Now, the retained consolidated retained earnings will now be the parent's retained earning plus that of the subsidiary. All right? So, what's the parent's retained earning in this question? Yes,
100,
someone.
100 million.
100
Sir,
million. 100 million.
I didn't get that.
100 million.
100
100.
parents retain earnings.
That's 90 plus 10.
So the 100 million is the parents retain earnings, right?
Yes.
Yes, sir.
Hello?
Hello, sir.
Yes, I can hear you. Go ahead, sir.
No, I don't have any question. I said it's 100 million for the parents. That's what I said.
So the parents retain earning is, don't forget that 100 million is the 90 million you got, right? Before the new acquisition, I mean before the 10% acquisition, the 90 million and the 10% of the 100 million, right? That makes 10 million plus 90 million, which is 100 million. Am I right?
Yes.
Yes, sir.
But don't forget to the parent still has from that 100 million as well.
I
As a
think we can
parent,
close another
from the
because
additional
we end in
100
1 minute.
million we made, from this additional 100 million, as a parent that I initially have 60 million, I still have 60% of from this 100 million. Oh, don't
The
I
call is
have?
about to end now. The call is about to end now.
Yes, if it ends, we'll come back online, sir. All right, once it ends, we'll come back online. I'll send another link immediately and we'll come back online. So now the parent company that initially had 60% still has 60% from this 100 million. No, apart from the fact that the additional 10% is getting 100 million, the parent company still has 60% of this 100 million. All right, now when we are looking at the consolidated retained earnings, we look at the retained earnings of the company itself, not on the subsidiary company. All right, the parents retained earning will have that. Then we have uh we had the 100 million made from the transaction from this particular post acquisition profit. We had that as well to it. Okay, so parents, let's say, I think the question is in the icon pathfinder also. So the parent company's share of the retained earning, not share, parent company itself, the retained earning of the parent company plus the 100 million gotten from the subsidiary company minus 5 million naira of what? 5 million of that equity adjustment. Okay, so that is that. When we get to our question, we will solve them accordingly. Now, the parent component, this. I think what we have here is what is also broken down here in summary. Now, the pattern of ownership in the consolidated statement. So the idea is that ownership determines how the results are presented, right? And when ownership changes during the year, you must split the profit. All right, so you must split the profit when the acquisition is during the year, we know that. And then when you are splitting it, you now have the share of the profit to the attributable to the owners of the parent as well as the NCI, the same way we have it in our income statement, consolidated income statement. So the situation one can be that we have basic control achieved, that is full year control. Now, when it is a full year control, it means that control is achieved at the start of the year or in the previous year. All right. So if we have a full year control, Hello? Okay. So now when we have the situation one, are we together, please? We can have
Yes,
situation one.
sir.
And situation one is when you have the basic control achieved, full year control. Okay. So the
Mr.
control is
Kasim, please, I want
achieved.
to ask a question while the time the class ended earlier.
Okay, sir. Go ahead, sir.
Sir, you were saying something that at least after the second purchase, then we after the second purchase of that 10%, our retained earning increased by 100 million.
Mm-hmm.
So and automatically the stake in the company of the parent has increased by 70%, has increased to 10%, making it 70% in all. So now, eventually you said the company, when we did 10% of 100 million to have 10 million, which makes 90 plus 10 million to have total parent share of 100 million. You went forward by saying that if you don't forget that the company already still has the original 60%. So are we going to calculate another 60% from the additional 100 million profit that was made?
No, don't duplicate
Okay,
it. Okay, don't
okay,
duplicate it.
okay,
No, you will
okay,
not. Okay.
okay.
So where we
Thank you.
treat that, we treat it in our question. All right.
Okay, okay.
Yes, sir. Now, for the basic control achieved, if a full year is achieved, that means the control is achieved at the beginning of the year, right? So we consolidate 100% of subsidiaries' revenue and expenses. We are not sharing it. We are not sharing it in periods like first period, second period, right? We are not sharing it. Instead, what we do is that we allocate the profit to the parent company and the subsidiary company. Unlike when you purchase a company during the year, for instance, now, if a company is using January to December and I purchased my what's it called? And I purchased my share on the 1st of July. So that means I'm only entitled to 50% of what they have there. Do you understand? 50% of the profit for the year because I joined them during the year. I hope that makes a sense. Does that make any
Yes,
sense,
sir.
sir?
Yes,
So
sir.
that is it. But if it was at the beginning of the year I purchased it, definitely the profit will also be at the beginning of the year, and we'll be sharing the full profit together. Okay, so that is that. Now, also we have a step acquisition whereby this one there was no significant influence, no control at all. All right, and this is where a parent company has a minority interest of 10% without influence. All right, 10% without influence. All right, yes. So if it is 20% down to 50%, we call it investment in associates, right? And that investment in associates is a significant influence. But where we have below 20%, ordinarily it is uh, a share in the ordinary business. Now, if a parent has 10% minority interest and also control is achieved during the year, do you understand? Now, where you have minority interest but you achieved a control during the year, so consolidation begins from the date your control is achieved. Probably, let's say during the year you decided to buy additional shares, right? Now you will start consolidating when that interest is achieved, when that control is achieved. Okay, so that is it. Now, someone sent a message to the group. Sorry, oh, let me check. Someone is mating. Someone asked me to let them in. I can't see anybody on the waiting list here. Okay, so now if the control is gotten during the year, then your consolidation begins when the control is achieved. Then also, for months before control, do not include in your subsidiaries report. Okay, you will not
Break this point
include,
down.
someone else
Break
will
this
have
last one down.
sorry.
Break this. I said break this one down. I didn't understand.
Yeah, I'm still breaking it down. You not allow me to finish this thing. You
Sorry,
have to
sorry.
break it down because I'm still on it. So what we are saying is that where you don't have control, you don't have to consolidate. Someone else has consolidated that result. So you don't have to prepare the report. All right? And that is that. Now, for months after control, you consolidate the revenue, the cost, as proportionate to the period at which you started having control. Okay? That is, you prorate it. All right? So that's it. So NCI is calculated based on the post-acquisition period only. All right? So if you are not the parent company, definitely you are the subsidiary. And for that subsidiary company, what do? You don't consolidate. You don't prepare the consolidated financial statement. So the parent company would have done that, and you can only recognize NCI after after you have control over the company. So that is that. Shall we proceed, please? Shall we? Can we proceed?
Yes.
Please,
Yes, sir.
please, will you be
Okay.
magnanimous enough to share this note with us?
And yes, my note is with the center, and the center will do that.
Okay, okay.
Yes, sir.
All right. Thank you.
Now, for additional interest. So what we are saying here, for months that you have control. Now, this is the example. So you have control in the business. Let's say before you had a minority interest, but during the year you purchased, let's say in the month of October, on the 1st of October, you purchased additional shares and you now have control in the business. So for those 3 months, you will prepare only the 3 months in your account. Your NCI will be 30%. If you have, let's say 70% is the additional interest you have. I mean, let's say the additional interest is 60% from the 10%. That means you now have 70%, right? So the 70% now is your parent's share. All right, so you will take 70% of the parent share for 3 months out of the 12 months. Does that make any sense? Because you started having
Yes, sir.
control, you started having that 70% from the 8th month. Is it the 8th month or the 10th month? From the 10th month. So you have the control in the 10th, 11th, and the 12th month. All right. So that's what we have here. So your parent profit will be 70% of your shareholdings multiplied by the profit times 3 over 12, which is the period at which you have the control. And the NCI is for the remaining 30% control you don't have in the business. All right. Hold on 1 second, please. 1 second. Okay, we can proceed now. Sorry, guys. So that is that your NCI is 30% of the profit, right? And you prorate it based on the number of months you have that NCI, as well as the share of parent profit as well. Now, for additional interest acquired after control has been taken, after you have control in the business, and you still have additional control. So parents already had control, let's say 60%, and then they now acquire additional 10% in September during the year. All right. So now you have to consolidate 100% of the profit. All right. Yes, you have to consolidate because you already have control, 60% control, right? However, the NCI share of profit must reflect that change in the holding, which will be splitted into the number of months, right? NCI for out of the 12 months, the first 9 months, we have 90% NCI. So NCI will share 90%, I mean, sorry, 40% NCI. So NCI will share 40% of the profits for the first 9 months. Then the remaining last 3 months, NCI will take 30% of the profit. Now, the key point here is to ensure that NCI's share of profit is accurate over time. Okay? Now, if you have an associate that is now upgrading to subsidiary, from associate to subsidiary, associate is what? 20%, right? Investment in associate, 20%. So anything above 20% is subsidiary, right? Now, a parent had significant influence of 40%, which is associate treatment. And later in the year, they buy more to gain control. Let's say additional 30%. No, this one is not associate to subsidiary. This is from subsidiary to parent. Subsidiary to parent. All right? So, yes, of course, 20% is associate, and 20% up to 50% or 49% is subsidiary. All right, so this will be subsidiary to parent. This example is subsidiary to parent because initially you have 40%, and then during the year you decided to buy another 40 30% to become 70%. All right, so the first one is your equity share of 40%. That means from January to December, January to September, you will take 40% of the profit, and then October to December, you consolidate in full. So this is subsidiary to parent. Subsidiary to parent. Now, the note there is that equity accounted profit, which is the associate, goes as one line item in P&L account. All right. Then also we have from date of control, you switch to full consolidation and adjust your NCI to that date. So that is that. Now the illustration that we have
Mr.
used.
Kasim,
Yes, sir.
please, the treatment of the situation 4, please, let's take it again, please.
Yeah, that's what we are explaining here. This is an illustration for it. So from January to September, you were an associate or a subsidiary, 40% at 40%, right? So we are using the equity method, whereby you take 40% of the profit between January to September. 40% of the profit in that company between January to September. Then from October to December, you became a parent company. That is when you upgraded from 40% to 70%. At 70%, you are a parent company, right? Am I right?
Sir.
So
Yes, sir.
that means from October to December, you can now consolidate in full and allocate 70% to yourself as the parent company and the remaining 30% to your NCI. Do we understand? Does that make a better sense now?
Yes, sir, to me.
Okay. So the summary of attributing to the summary of attributing to total comprehensive income is to calculate the total consolidated profit. Please, whenever there is someone to be admitted in, kindly let me know in case you have information. Let me look at
There's none for now.
Mr. Ismail. That place is noisy. If you can mute yourself. Thank you, sir. Now, for the income statement, all right, you have to calculate the profit that will be attributed to the parent and the NCI. All right, so you are calculating the parent the profit for the parent based on the number of days you were. Let's start with subsidiary now. You were initially a subsidiary, right? You share your profit from that subsidiary based on the number of months you were a subsidiary person, a subsidiary company. All right, so that's what you should have. Then Also, that is we are saying that you take your percentage, which is 40% for the 9 months you are a subsidiary, you were a subsidiary, and your profit, that is 40% of the profit in the income statement for 9 months. All right. While the remaining 30%, you are taking 70% of the profit for the remaining 3 months. All right. So that is what we have here. Do we have any question? So let's look for a Pathfinder question. Okay, I received a notification for someone who wants to come in. The person is coming in and going out. Okay. So let's solve a question. Business combination achieved in stages. So I'll send this to our group now. Shall we proceed, please? Shall we look into that question? I've sent it to the group. We have two questions. One is November 2018 question 1 and November 2017 question 1. So let's start with November 2018 question 1B. Does anyone have the material?
Just download it, sir.
Okay, please download November 2018. I can send it to the group. I can download and send it to the group.
Please send it to the group for us, please.
November 2018. Yeah. I've sent it to the group, but kindly confirm, please. I've sent it to the group. Please confirm when you see it.
November 18, question what, please?
Question 1.
Okay, thank you.
Can you still see my screen? Can you see the Pathfinder on the screen?
No.
Okay, that means I'm not sharing the entire screen. I'm only sharing the material. Okay, let me see if I can share something else. Paid and bias correction. You can see the question, right? Can we see the question? Hello, are we there?
Yes, please, you can see the question. Thank you.
So who is reading for us?
Read.
Sorry?
Can I read? Can I go on?
Go ahead, please.
Thank you.
Start with the
Okay.
requirement.
Okay, sir. All right. Requirements. Okay, required. Number one, briefly briefly explain how this additional acquisition will impact on the preparation of Adilab's consolidated financial statement for the year ended 31st December 2017. Two, calculate the adjustments that will be required to be made to Adilab's statement of financial position as a result of this acquisition.
Okay.
Oh, sorry. Requirement A, sorry. Prepare for Ade Gaga Laboratory PLC a consolidated statement of financial position as at December 31st, 2017. B. On January 1st, 2018, Adelabs acquired additional 10% of the equity shares of Bodegas. The purchase consideration for this additional acquisition was 52,500,000 required. Briefly explain how this additional acquisition will impact on the preparation of Adelabs consolidated financial statements for the year ended 31st December 2017. B. Calculate the adjustment that will be required to be made to Adelabs statement of financial position as a result of this acquisition.
So now you
Then
will
the
have to
question.
start from the beginning again. You read the question from the beginning because this B question is an additional acquisition, right?
Yes, yes,
It's an additional acquisition, and then we need to know how it will be treated, right? So before we can
yes,
know how to treat the additional acquisition, we need to understand how much was initially acquired. Am I right?
yes.
Yes,
So
sir.
how do we, even the question is asking us, explain how the additional acquisition will impact on the financial statement. The question did not ask you to solve it though. The second one is the one saying that calculate the adjustment that will be required. The question is not asking you to solve that additional acquisition. Oh. Abi,
Yes, I think it's brilliant explanation for this second requirement. Just in
it's an
writing
explanation.
note.
So how do we treat it now? So going by what we said in our notes, that's you just need to explain how this additional. So you look at the question itself. Do you get my point? You need to look at the question itself, and then if it was if the company already had a control before the additional acquisition, there is a way to treat it. If the company purchased it during the year, there is a way to treat it. If there was no control at the beginning before the before additional acquisition, there is a way to treat it, right? So that's what we have here. Do you want to read the question from the beginning? Can we read the question from the beginning to look at what we have, the type of acquisition, whether the company had a control before the new acquisition or not? Shall we look into that? Hello?
Hello, sir, Mr. Kazim.
Should we read the question from the beginning to know whether the company initially had a full
Yes, let's go
acquisition?
ahead and read.
Eh?
Let's go ahead and read.
Okay, so who is reading for us, please, from the beginning? I hope you have the material
Let,
there.
let me read.
Please go ahead, sir.
1 minute, please. Adegaga Laboratory PLC, Adelab, is one of the largest companies in Nigeria, engaged in cosmetic development and manufacturing. Its largest customer base is in the healthcare sector for post-surgery patients and the Nigerian movie industry, aka Nollywood. In the prior financial period, Adelab's expansion strategy has been largely focused on growth by acquisition and joint ventures. Additional information. As part of this, Adelab acquired 80% of equity share capital of Bodegas Limited on January 1, 2015, when the retained earning of Bodegas was 93.75 million. Following the share acquisition, Adelab had control over Bodegas. No shares have been issued by Bodegas following the acquisition on January 1, 2015. The NCI in Bodegas was measured at its fair value of 20 million at the date of acquisition. On January additional information too. On January 1, 2016, Adelab acquired 50% of equity share capital of Chid Plastics Limited when the retained earning of the Chid Plast was 41.25 million. This acquisition was classified as a joint venture in accordance with IFRS 11 joint arrangement. Chid Plast has not issued any shares since the acquisition date. Note 3. The balance on other reserves relates to movement in the value of investment in Bodegas and Chid Plast in the books of Adelab. 18.75 million relates to Bodegas and the remainder to Chid Plast. Note 4. Adelab's non-current liability relates to a borrowing long-term taken out on January 1, 2017. This borrowing has an agreed coupon rate of 4% per annum, and the interest expense due in respect of 2017 has been paid and accounted for in the profit for the year. The effective rate estimated with the financial liability is 8% per annum. Note 5. As part of its annual impairment review, Adelab concluded that the goodwill on acquisition of Bodegas was impaired by 20% at December 31st, 2017. No other impairment of goodwill have arisen. Note 6. Adelab sold goods to Chidplast with a value of 75 million and a selling margin of 40% in November 2017. As at year-end, 31st December 2017, 75% of these items are unsold. Accounts for all the companies are made up to 31st December annually. The draft statement of financial position for Adelab, Bodegas, and Chidplast as at 31st December 2017 are as follows. So required, prepare for Adegaga Laboratory PLC, a consolidated statement of financial position at 31st December 2017.
Okay.
So I'm done, sir.
Okay. Now, what do we see in the question? Just can anyone tell us about the questions? What do we have in the questions?
Adegaga already has control since it has control of Bodegas already. Since it
Okay.
acquired 80% of Bodegas shares.
It's already had how many percent?
80% of equity share capital of Bodegas.
Okay. Now it's buying
And
I,
the remaining
I
for
10%.
I think it's one subsidiary and then one parent and then a joint venture.
Okay.
Because that Chide Plast is supposed to be a joint venture, and then Bodegas is supposed to be a subsidiary.
Okay. Now, my question is this. The question says that we should prepare Adegaga Laboratories PLC financial statement.
Pemi Sire, can your background is noisy. Can you help allow us here, please?
Sorry, let me help her.
Go ahead, sir.
Let me look for. Let me see.
Sorry, I've muted already. Sorry.
Okay. Now, we are to prepare for Adilab, right? Right? Now,
Yes, sir.
initially, how many percentage does Adilab have?
It have 80% in body gas and
At as
50%
at
in
what date?
2015.
As at 2015, it had 80%, right? Now, there is now an additional acquisition of 10%, which will now increase it to 90%, right? Am I right? Hello?
That 10%, additional 10% will be in accordance to requirement B, not in accordance to requirement A, if I'm right.
What does requirement A say? What does B say? A is
The
saying,
A is saying, okay.
A is saying we should provide the financial statement in consolidated financial
Yes,
statement,
that's
right? No,
consolidated
no.
statement.
We are here to focus on
Ma,
B1. All right, B1 and B2. That's what we are here to focus on the additional
Okay,
acquisition. So
okay, okay.
what do we say about this additional acquisition? So for the additional acquisition, when was it purchased? Adela purchased additional one on the 1st of January 2018. The company's accounting year end is when? 31st December, right?
Yes, yes, sir.
Which is not during the year, which means the asset, I mean, the additional acquisition was for a full year, and the company already had the business control over the business, right? Am I right?
Sir, yes, sir.
yes.
Okay. So what do we have next? So what are we supposed to do to this? How do we treat it? What does the
Um,
question say?
Adelab is going to consolidate 100% of the subsidiary
Good.
since it already exists since beginning of the year. So, and it already has control.
So Adilab has control,
So then
right?
the NCI we're going to split the NCI, the first 80%, and the NCI is going to be for the first half of the of all the stuff. The first splitting will be 20%, while the second one will be 10%.
When, for which period?
I mean, okay, okay.
It's
Oh,
not up to the
sorry,
year. Oh.
it's
Don't
not
make
during the
mistake.
year.
Oh.
It's at the beginning of the year. Yeah.
Eh.
Thank you, sir.
So the only thing here is that Adilab will consolidate this account. It will consolidate in full because it already has control in the company. All right. And we told us how to recognize the value of the shares and the adjustment in the equity, right? So all those things are the same thing. It's just for you to explain. It is theoretical. Your B1 is theoretical, and your B2 is saying that calculate the adjustment that will be required to be made on Adilab's statement of financial position. So what will be the adjustment now?
The
Repeat the
change in
adjustment in
return
our notes
earning,
now.
the change in return earning, the change in controlling interest.
So the parent's own profit, the parent's share of profit, plus the retained earnings, right? Plus the share of retained earnings minus the adjustment, right? So this is what we are saying here. This is what we have here. So this one is during the period, and this is the one. Let me look for it here. Additional interest after this during, not this during the year, this during the year. So this is the components of the. This is for retained earnings. This is for retained earning. So the parent retained earning plus the subsidiary, and then if there is any adjustment, all right. So and the adjustment is the share capital. I mean the consideration you paid minus your share of post-acquisition profit, right? The adjustment. This is what we have here. This is its equity adjustment. This is exactly what the question is asking you. Is that not it? The question is saying calculate the adjustment that will be required on the statement of financial position on the acquisition. And what do we have in the question? Here, your NCI, what's the new NCI you have? Your NCI has reduced, right?
10% now.
So what is the acquisition? What is the purchase consideration? What's the purchase consideration
52
in this
million
exercise?
500. 52,500,000.
52,500,000 is the purchase consideration.
The
All right.
additional purchase consideration.
So this 10%, we will share the profit at the end of 2018. Someone wants to come in, I guess. Okay. Right. So the NCI now, the post-acquisition profit to be shared, which is 10%. Where am I, sir? Where am I going to? So the post-acquisition profit of 10% will also be shared at the end of the year. Right?
Yes, sir. Yes, sir.
And that will be 2018, at the end of 2018. The financial statement given to us here is for 2017. So we don't know what the post-acquisition profit is, but we know that we need to recognize the purchase consideration and less the post-acquisition profit from it to give us the adjustment. All right. So what is the accounting entry to this now? The accounting entry will now be when you bring in an investment. What do? When you buy an investment, you debit an investment being an asset and credit. Am I right? Are you debiting an investment?
Yes, now we
Yes,
are
your
debiting
investment is an
our
asset, right?
asset.
Am I right?
Sir? Oh, did you come again?
When you purchase an investment, you debit the investment,
Yes.
right?
Yes, sir.
And you credit your what? If
We
it
create
is your
our, we create
investment,
our cash.
no, now you can't credit your cash now.
Yeah.
Okay, you personal account. Okay, from the company that is buying the investment now, yes, you credit your bank account and debit your investment. Why the company you have invested into will receive your bank account, will receive the money, debit their own bank account, and credit their equity. Is that not so? Do you need me to repeat that?
Come again, sir.
Okay. The investor who has invested, I paid money to invest, Abby. I bought shares
Yes, sir.
with my money, right? Am I
Yes,
right?
sir.
That means I will
Yes,
debit
sir.
my investment and credit my bank account, right? If you don't understand me, just speak up, don't worry. I'll
I
debit my
understand.
investment as the purchase and then credit my bank account, right? Is that it? Is that the double entry account?
Yes, sir.
So I debit my investment, I credit my bank account, right? Now, for the company that I have invested into, that one, they will debit their own bank account, right? For receiving money into their account. And they credit what?
Equity.
My equity, as simple as that. So that is that. Any question? Any question? Okay, let's quickly look at the second question we have that I sent to the group. What's the second question? What's the diet? What's the diet? November 2017, question 1. November
Sir, please kindly help us
2017
send the
question.
question.
Sorry?
Kindly help us send the question to the platform, to the group, please, sir. The Pathfinder. Thank you, sir.
November 2017. This is for skills. Sorry, I don't have it close by. I have for skills here. Oh, November 2017. I'm using May. And this is for skills. If anyone has it, please send it to us. Oh. Anyone who has downloaded it should please send to us.
Someone should download it now. Sir, which year?
I'm trying to download it to November 2017. It's not coming up here.
Okay.
November 2017. It's not downloading from the icon pattern.
No, I'll send it shortly. So
Okay, sir. Thank you.
I sent it.
Okay. Thank you, Winner, for sending that 2014 to 2024. Please, are we there now? Let's go to the requirement first. Are we there, please?
Yes, sir.
Can someone read for us, please? Start with the requirement.
Question one, I'll be with of the question.
Yes, sir. Question 1.
Require prepare the consolidated financial statement of Papa Group as at March 2017.
Okay. Now the question itself.
The question, the following are the financial statement of Papa, Tata, and Chebe. You are also provided with the following information, which will be relevant to the consolidated financial statement of Papa PLC.
Tell us Papa
None of,
acquired.
sorry?
Let's look at the acquisition.
Okay. Tata, this is a question of
No,
Tata.
Papa acquired the following shareholdings.
Yes, in Tata and Chebe. It acquired in April 2014. It acquired 30. It was already originally having 30% as at 1st of April 2014 at a fair value asset of 325 million with purchase consideration of 120 million. So in April 1, 2016, it increased its holdings by 50% when the fair value of the asset was 460 million with CT of 260 million. Then Chebe, April 1, 2016, it was already having 25% at fair value of the asset was when the fair value of the asset was 400 million and the CT is 60 million. Can I go on?
Yes, sir.
You are also provided with the following information, which will be relevant to the consolidated financial statement of Papa PLC. None of the companies has issued any additional share capital since April 1, 2014. The financial statement of Papa have not yet been adjusted for the gain or loss arising on gaining control of Tata. On April 1, 2014, the carrying value of net assets the carrying value of net assets of Tata was the same as their fair value of 325 million. Papa PLC wishes to use the full fair value method of accounting for the acquisition of Tata, and at April 2016, the estimated value of goodwill attributable to NCI was 3 million. The estimated fair value of the initial investment in 30% of the shares of Tata was 150 million at March 31st, 2017. Included in the tangible non-current asset of Tata is land valued at cost, which on 31st March 2017 had a fair value of 25 million in excess of its carrying value. There has been no subsequent significant change in that value. At April 1, 2016, the fair value of Tebe's land was 16 million in excess of its carrying value. There has been no subsequent significant change in that value. Goodwill arising on acquisition is tested for impairment at each year end. At March 31st, 2017, an impairment loss of 15 million was recognized for Tata. There has been no impairment of investment in Chebe required. Prepare the consolidated statement of financial position for Papa Group as at March 31st, 2017.
Okay, now. Now, if you look at investment in Tata, we have step-by-step acquisition, piecemeal, right? And that's what we want to focus on this evening. Now, for this investment, all the value of the investment, the fair value of the investment at the date of acquisition as at 2014, the initial investment was 325 million, right?
Yes,
That's the fair value of the net asset.
that's it.
But what about the fair value of the those? Do we have any information on the investment itself? The information on the purchase. Okay, at April 1st, 2014, the carrying value of the net asset was 325 million. So which means this 325 million is the carrying amount, right?
Uh,
Right? Are we
yes,
together,
sir.
please? Hello? Is anybody there?
So we are with
Yes.
you, sir.
Okay, I stopped hearing voices. Now, so we are here now. So the carrying value of the net asset, this net asset is 325 as at the date of acquisition. Now, Papa PLC, who is this person coming in? Hold on, please. Let me admit that person. Now, Papa PLC wishes to use a full fair value method of accounting for the acquisition of Tata. Do we understand? Full acquisition, which is fair value model. I don't know if you understand that. Which means we are not using the net asset. Please, do you understand what I'm saying?
Yes, sir, I do.
We are not using net asset to get the value of acquisition. We are not
For the
using
SPI.
net assets to ascertain the net asset at the value at the date of the business. They gave us the fair value. So the fair value at April 1st, 2016. Okay, no. Okay, so we intend to use the fair value model, right? And at 1st of April 2016, don't forget, we purchased Tata at 2014, not 2016. The first in acquisition was
So the
2014.
meeting has ended though. Another link.
Me is stressing. Okay, so we are talking about the additional acquisition, right? Now, for the additional acquisition, in 2014 we purchased 30%, but we are using fair value now. Now, wait, oh, Papa PLC wants to use fair value. Now, as at April 1st, 2016, the estimated value of goodwill attributed to NCI was 3 million. The estimated fair value of the initial investment. Now, don't forget, this Tata, I'm coming. Let me explain what I'm saying first. Now, the estimated fair value for the initial investment in 30% of the shares in Tata was at 150 as at 31st of March 2017. The following day, we bought it on the 1st of April. As at 31st of March, it was at 150 million, which means the fair value of the asset was at 150 million when we purchased it. We are not using the net asset of 325 million. Please, am I correct?
Yes, sir. Yes, sir.
Does anyone, only one person is saying yes, so do we understand what I'm saying here? Those of us online. Remember I told you had to unmute yourself. All of us are to talk in this class.
So I don't know where we are.
The exact word I'm expecting from one of you. I knew somebody would say that. Yes, I'm serious. I've been dealing with students. I've been taking students in ICANN starting from 8 years since 2012 or 2013 now, or 2014. Let's say 2014, right? And there is no way you'll be solving a question. At almost the end of that question, you will not see somebody that will tell you that, where are we? I don't know what we are solving, or I don't have the pathfinder, or I don't. Somebody will say something. I knew it. Thank you for voicing out. Do you know the pathfinder we are treating? Do you know the pathfinder we are treating? Who is that person? Say, what's your name, please? Help us with your name.
Yes, please. November 2017,
Okay, now
question
Miss
1.
Mavis. Miss Mavis, right? Now,
Mrs. Mavis Obasi.
okay, Mrs. Mavis. Sorry about that. Now,
Yes, sir.
it's okay that
Yes,
you
sir.
don't know what we're doing all this while.
Yes.
Though. It's okay. But do you know where the error is? The error is that you did not speak up on time until now. I always say it. It is okay when you are lost or when you don't know what we are doing. But the problem is when you don't speak up, immediately you realize that. So that all of us can go together. So thank you for speaking up. It is not too late. Now that you have spoken up too, it's not too late. All right? We are still at the beginning
Okay,
of the
sir.
question.
Okay, sir.
Now we are taking November
Thank
2017.
you.
Right? November 2017, question 1. Do you have the
Yes, sir.
question?
Yes, I'm with it. I have it.
Okay. November 2017, question 1. Now, we are, if you are, I don't know if you can see my screen, we are on page 4 of that material. Looking at the acquisition, the shareholdings of the parent company in its two subsidiaries, its investment. All right. Now, as at
Yes, sir.
April 2014, the company only has a significant influence. All right. That is investment in
Yes, sir.
associates or subsidiary. We have 30%. We don't mind.
Yes,
Now,
sir.
at that
Yes, sir.
30%, the value of that investment was 150 million fair value, but the net asset was 325 million. Do you understand me?
Yes, I do.
Now, the question is telling us that Papa PLC, which is that person we are consolidating for, has decided that he is not using net asset, this net asset. No, fair value of net asset. Man, we are not using that. Now, we should use the fair value model of accounting for the acquisition of Tata. All right. Now, what is the value of
Yes.
Tata as at this date when we first initially purchased it? The fair value was at 150 million. Right.
Okay.
Now, out of
Yes,
that
as at
150
31st
million,
March 2017.
yes, in 2017, no, okay. The estimated fair value of the initial investment in Tata was 150 million as at 21st of March 2017. No, that is an error. No, our initial, the question should be 2014. Why? Look at it here. The estimated fair value of initial investment in 30%. This is when we did our initial investment. It was in April 2014.
Okay.
So I think this 2017 is an error. It's meant to be 2014.
Okay.
All right. So the initial fair value was 150 million. Right? So
Yes.
now 150 million. Now, what was our purchase consideration? 120 million. Am I
Yes.
right?
Yes.
Now, between the first acquisition and the second acquisition, how many years? How many years? 2 years, right?
It's 2 years.
Now,
Two years, yes.
within those 2 years, what is our profit? What is the retained earnings? Let's go into our retained earnings. What's the retained earning of the company? What's the retained earning of the company between 2014 to 2016? Where is
It's
the retained
210.
earning? Eh? Now I'm looking for the retained earning.
210
210. Where did you see 210?
for Tata.
Where is the retained earning?
After the evaluation reserve,
Tell us the
under
one figure
the
number.
financial statement.
In the financial statement,
Okay.
is it this one? No, this one is as at 2017.
Okay.
We won't use this one. That's at the date of consolidation. All right. So now let's look for what our
Retain earning.
retained earning is. Has anyone seen it? Someone should please help us. What's the retained earning? Retained earning. Has anyone
So
seen this retained earning?
I don't think we're given retained earnings
Are you
in
sure?
addition.
It's not possible they don't give us retained earnings now. So where do we get our retained earnings from? Okay, well, let's say I wouldn't say it's not possible actually. I still will not say it's not possible. We can find our retained earnings. All right? We can find the retained earnings of the company. And how do we find the retained earnings of the company? How do we find the retained earnings of the company? Anybody? Can anyone say it? So the retained earning can be gotten from this fair value of the net asset as at the date of acquisition and date of consolidation. All right. For instance, now our retained earning for 2016 was 460 million, right? I mean, the fair value of the net asset was 460 million. Now, don't forget what to make up the net assets. What are those things? What are the components of that net asset? Anybody?
Share capital, share and other reserves.
Share capital, premium. Then if you have reserve, if you have retained earning, general reserve and
Yeah,
retained earning, right?
yeah, yes.
Okay, so we can have our retained earnings to be here. Now, there's an information on this. So let's look for, we have additional share, no additional share, financial statement adjusted for gain and loss. Now, the financial statement of Papa have not yet been adjusted for gain and loss, or loss arising in gaining control of Tata. Okay, fine. The carrying amount, the carrying value is 325 million, which we have seen, and the NCI was at 3 million, fair value was at 150 million. Now, included in the tangible asset of Tata is land, valued at cost, on which valued at cost, which on the 31st of March had a fair value of 25 million. Do you understand? In
Yes,
excess
sir.
of its carrying value, which means what is our land and building in this asset? They didn't give us land and building separately. They just wrote it under tangible assets, right? Now, the land, what this information is saying that is that the land has a value, a fair value of 25 million in excess of that carrying value. There has been no subsequent significant change in that value, right? Which means there is no impairment. Now, this question, what are they saying here? They are saying that from this fair value of 25 million has not been considered. Or has it been considered?
No, sir.
So, no, it was considered on the 31st of March, right? It was considered on the 31st of March. Now, which means if you see this 1 million and something that we have, or what is it, 440, this asset has an on it has that fair value, what's it called?
Fair value adjustment.
Fair value adjustment. Thank you. All right. Now, as at 2016, when we have this our at the beginning of the year, there's nothing like this fair value. This 460, as at this 460, there's nothing like this fair value of 25 million, right? The 25 million is at March 2016. I mean 2017, which is at the end of the year. Am I right? Hello?
Yes, sir, you are right.
Okay. As at the beginning of the year, no, it has been included. Included in the tangible asset, which means this fair value of 25 million has been included. Now, that 25 million, we are trying to break out, we want to get the retained earning from this 460. I don't know if you understand what I'm saying. The retained earning between 2016 and 2017 for Tata is 440 and 460, right? That means the retained earning came down in 2017. But before that 2017, we have this 460 as their retained earning. Now, as their net asset. We want to bring out the element, sorry, I'm comparing net assets to tangible assets, please. The net asset here is 470. The net asset here is 460, right? Now, which means it has increased by 10 million. Let's leave that 10 million. That is the post-acquisition profit. Am I right? Between 2016 and 2017, right? Does anyone understand what I'm saying? Hello? Hello?
Hello, sir. Why is the 10 million increment, sir?
Okay, now, as at April 1st, 2016, our fair value of net asset is 460, right?
Yeah, yes, sir.
As at 31st of March 2017, what is our net asset? 470. Is that not it? Hello? Hello?
Hello, sir. I said, are you making reference to 470 under Tata in the?
Yes, now that's what I'm doing. I
All right,
said
sir.
what is the fair value of the net asset of Tata as at the beginning of 2016? 460,
Okay.
right? April 1st,
Yeah.
2016. The accounting
Yes,
year
sir.
end will be 31st of March 2017. Abi?
Yes, sir.
At the beginning of the year, fair value of the net asset was 460. At the end of the year, we have it as 470. Is that not what we have?
Yeah, yes, that's it. That's it.
We have it at 470 at the end of the year, right?
Yes, sir.
Uh-huh. So now this net asset, don't forget, from this 460, we definitely have their equity capital and their share premium of 240 and 20. Am I right?
Yes, sir.
Uh-huh. So we are trying to break out what is the element of retained earning from this net asset at the date of acquisition, at the beginning of the accounting year. Do we understand that, sir? Do we understand that, sir? Hello? How many of us are in this class? Please, everybody, let's start marking attendance. I don't know how many of us are in this class, please. How many of us are here?
Hi.
I'm here.
Nobody is saying anything.
I'm here. I think we are five in the class.
Only one
Plus
person
you.
is responding. Let me
And
know
we
if
are
you
still trying
understand
to,
me or not.
like me, I'm still trying to understand the question.
See, I've said it before. If you don't understand, speak up. If you don't speak up, I will assume that you know it, or I'll be moving around without knowing what else to do. If you don't understand, say it, not silent. That's why I'm asking questions. That's the essence of my question. So that if you don't understand, you tell me I don't understand. Then I will know what to explain.
Okay.
No problem, sir. We'll do that.
Now, let me go back to the question. At the beginning of the year, this is April 1st, 2016, right? The accounting year end of the company is what? What's the accounting year end of the company?
31st March 27. 31st
Every
March
year,
every year.
right? Now, which means for this 2017, the beginning of the year will be 1st of April
First of April
April
2016,
2016.
2016.
right? Am I
Yes.
right?
Yes, you are right,
Now,
sir.
if 460 is my net asset as at 2016 at the beginning of the year, I'm saying that I want to get out of this 460, what is the retained earnings there? And how do I get the retained earnings? From this 460, if you want to know the component of the 460, come to the financial position. You will see that from that 460, now we have it at 470. As at the end of the year, we have it at 470, right? Am I right?
Yes, sir.
Yes.
Now,
Yes,
before
you
we
are
get to
right.
Yes,
that
we have
Yes.
470,
possibility.
some things are always not changing in the financial statement, of which this statement also says it, that none of the companies has issued any additional share capital since April 2014. Do you understand? Since April 2014, we have not issued any additional capital, which means this share capital we have here and the share premium of 240 and 20 has been there since 2016. Am I right? I mean, has been there since 2014. Am I right?
Yes, sir.
Do you understand what I just said?
Yes, sir.
Who does not understand,
Yes.
please? If you don't understand, please speak up. Okay, I can proceed then. Now, which means out of this, from this 460, eh, 220 is there as the ordinary share capital. Share premium is there of 20, right? Right from time, we don't have revaluation reserve, and probably we don't have at all. So let's leave the revaluation reserve as well. Then also we have our retained earnings usually, right? Now, From this, our net asset, the question told us that included in this net asset, we have 25 million excess of our land, which is a fair value adjustment on the land. Do you understand? Now, we want to get the element of the retained earnings. How do we do this? Let me see if I have, yeah. So let me show you how to get the retained earnings here. This is the last week Excel sheet we solved in the class. Now, this diet is when? November 2017, right?
Yes, sir.
November 2017, question 1, right?
Yes.
What's the name of
Yes.
the account?
Papa. Papa.
Papa Tata Achebe. It's Papa Group.
Papa Tata
Satan is today.
Achebe. Now, let's calculate their retained earning. Of retained earning.
So I will not see your screen, oh.
Oh, I thought I'm sharing the entire system.
Yeah, I can see it. Oh.
Aha.
We
Rather,
can
it
see,
is
I
your
can see it
network.
from here.
Okay, I'm seeing it now.
So let me zoom in. So calculation of retained earnings as at 1st April 2016. No, let me calculate for all the retained earnings. So I will signify which one is for 2016 and which one is for 2017. All right, my question is in million. Now, the fair value of the company, fair value of net asset, as at 1st of April 2016. What's that fair value, please? What's the fair value?
150 million.
150 million. Okay, so the fair value is at 150 million. Now, this 150 million, from the 150 million, we want to know what the retained earning was. All right. Now, from that 150 million, we have
Yes, I
the
can see it.
yes,
Sorry to
sir.
draw you back. Sorry to draw you back. The net asset I called is as at March 31st, 2017. Is it the same thing?
I didn't get you.
Although, I think the figure I called is at 31st March 2017. Although you said perhaps there's a mistake with this date the other time.
Yes, there is a mistake in the dates.
Okay.
The fair value should be at 2014. Or maybe, or another thing is this: the fair value has been like that from the beginning up to that 2017, right? But in actual sense, the question, what I'm looking at here is that the estimated fair value at the initial investment in 30% of the shares in Tata. When did we purchase 30% of shares in Tata? 2014.
2014.
Do you understand? So that's why I'm saying that there is an error there. I'm not just assuming, no. I used
I
the initial
understand.
statement and I assume that the last date is wrong. All right, so that's it. Now, the share capital is part of this 150 million, right?
Yes, sir.
Oh, so what you have given me is the fair value of NCI, or what did you give me? Where is it, sir?
Yeah. What I give was for NCI was
No,
for.
I said
Okay.
net assets. This is the fair value of the
Okay.
net assets. 460 as at 1st of April 2016. 460. 460. Now, from this net asset, we have the share capital, and the share capital is here. They already told us the structure of the company. This is the structure of the company. All right. In their structure, they have share capital, they have share premium. And the question told us in Roman figure 1 that starting from 2014, April 2014, this structure of share capital and premium has not changed. Am I right? Is that in the question? Do we have it here?
Yeah, it's there. Question note
So none
one.
of the companies has issued any additional share capital since April 2014, which means the share capital and the share premium has remained constant since then, right? So which means we have 240 for share capital, and what's the share premium?
It's 20.
20. Do we understand this now? Now, these two, we need to remove it from whatever we have here. That will give us what? Minus 260, Abi? Am I right?
Yes.
Okay. Then what else is in this 460? They told us that included is also 25 million in excess of its value, the fair value of the land. Right? That means we have fair value adjustment for land. It's part of this 460 million. Fair value adjustment for land. How much is that? 25 million.
25 million.
25.
Right? Now, if all of these are gone, what else do we have here? The next that we'll be having, apart from that, the next thing we'll be having now is what? Will be our retained earnings, right? We've taken share capital, we've taken share premium. There's nothing in the reserve. So which means we have retained earning. So what is our retained earning here? The difference between all of this is what will be our retained earnings. And what is our
To
retained
be
earning?
175.
Sorry?
175.
Can someone else confirm that? I'm also using my Excel. So we have 175. It means the retained earnings at the beginning of the year, at the beginning of this 2016, is this 175. Retained earnings as at 2016 is 175. Please, does this make any sense? Do you understand what I've done, please?
Yes, I do.
Okay. Now, don't forget, what we actually need is the retained earning as at the date of the initial acquisition. That's what we need, though. The retained earning as at the date of the initial acquisition, this 325. We want to know what the retained earning is. The retained earning that forms part of that 325 is what we want to know, right? Now, if 325 is what I have, if my retained earning as at the date of the new acquisition, 2016, as at the date I'm buying the new asset, the retained earning is 175. As at the date I am upgrading my account, right, is 175. How much was the initial retained earnings from it? Don't forget what we did. The example of what we are saying is this. The question earlier that I said retained earning before we first acquired was 150 million. Now, our first purchase, the retained earning, this question. Our first purchase, the retained earning was at 150 million at the date of purchase, right? Then before the second purchase, retained earning was already at 300 million. Between this 300 million retained earning and the 150 million retained earning, we have additional 150 million retained earnings, right?
Yes, sir.
This is exactly what we want to do. Now, we've gotten the retained earning as at the second purchase. Is that not so? Which is as at the date of second purchase of 460, April 1st, 2016. Right? April 1st, 2016 was the date of the second earning. Now, what about the retained earning in the first purchase? Alright? So let's look at the retained earning in the first purchase. In the first purchase, what is the net asset?
It should be 325.
325. Oh, sorry.
Yes.
Now, from that 325, we said that this share capital and share premium, they are constant, right? Since that 2014. Am I right?
Yes, sir. They are
Okay.
constant.
Now, if they are constant, that means these two of them are there. So that means I will have them again. Share capital of 240, share premium of 20. And nothing has changed, right? So when I less
Yes.
260 from here, what do I have?
The 65.
We have 65. Now,
Yes.
that means the retained earning as at the initial purchase of 2014 was 65. The retained earning for the second purchase as at the date of the second purchase was 175. Does that make any sense? Does it make any sense now? Like, do we have something like this now? Initial acquisition. This is the purchase consideration and the percentage. Retained earning as at the date of first acquisition, retained earning as the date of second acquisition. Does it make any sense now?
Yes, sir. Kind
Okay.
of.
Yes,
Now,
sir.
Kind of.
so after getting the two retained earnings, let's look at what is our control. Do we have a profit on the control or a loss? Don't forget, we were initially an associate or a subsidiary, right? Before we became a parent. Am I right? Am I right, please?
Yes. Yes.
Now,
Yes,
let's
yes.
look at whether we have gained in our acquisition or not. So now, let's do that. Now, let's calculate the gains. Let me take this as my workings 1. Let me take this as workings 2. So now, we want to check if there is a gain or loss on acquiring control. All right? Control of which company?
Tata.
What's
Of
the name of the
Tata.
company we are acquiring control on?
Of Tata.
Tata. Thank you, ma.
Yes.
So let's see the gain from there. Okay? Now, what is the fair value of NC Tata? Tata.
150 million.
Now, the fair value of Tata itself, of the value we purchased, right, is 150 million. The estimated fair value of our shares, not NCI, the fair value of our share was 150 million, right? So the fair value of what? That's the first investment, right? Initial investment in Tata is how much? 150 million, right? Now, from this fund 150 million, how much did we pay for the investment? What's the initial cost?
120.
Okay, 120. All right. Now, let's look at the retained
I
earnings.
think it's 120.
I've written 120, ma.
Purchase consideration 120.
Yes, that's the cost, right? Am I right? So let me use purchase
Yes, sir.
consideration.
That's the cost. Yes,
So
sir.
purchase consideration of initial investment. Purchase consideration of initial investment is 120, right?
Yes.
Now, what's the retained earnings? What's the retained earnings that we have between the initial investment and the subsequent investment, which I said we should share it before the new investment came in, right? Did I mention that before?
Yes.
Uh-huh. So we have to share the profits. All right. Now, at the initial investment, the retained earning was at 65. All right. But at the additional investment, before we, after the first investment, before the second investment, the retained earning was at 175. So the difference between 75 and 175, we need to take 30% of it, right? Am I right?
Yes.
Uh-huh.
Yes, that
Share
is
of
33,000.
retained earnings. After initial share of retained earnings before second investment, right? Before additional, what should I use, please? Somebody should give me what to use. I can use before the new investment, or I can use before the second investment, or the additional share, additional equity. I can use anything. I just want, if you have any word that is better, that is will be better simplified, that you can understand better when you are treating it, please give me that.
Can you say share of retained earning between 1st April 2014 to 2016?
Or between first and second investment.
Okay.
For the period before second investment.
Okay, so share of retained earnings before, no, at the date of second investment,
Yeah.
at the date of additional investment. So what is that profit? This one, let me do it like this, and I'll put it here. At the date of additional investment. Now, what is that profit? What is the retained earning? 175, right? 175 minus 65. Am I right?
Yes.
Yes,
Times how much? What's our percentage?
30%.
What's
It's
the initial percentage we
30%.
have? 30%, right?
Yes,
So times 30%. So what does that give us?
33.
33. Please confirm it. Oh.
Yes.
Somebody should please confirm it. Oh.
Correct.
Okay. Now, this is the true investment. Now, which means the value of our investment now in Tata, the value of that first investment of 150 million, of the fair value of 150 million, which we paid 120 million for. The investment value now is not at 150 million anymore, right? Because we've added retained earnings to it. Am I right? Am I right?
Yes. Yes.
So the carrying
Sir,
amount of our
Yes, sir.
investment in Tata of first investment. I don't want to use initial because it will take more space. First investment, okay, or initial, since that's the only thing. The carrying amount of initial investment in Tata will give me how much?
87.
Sorry?
87.
How did you get 37, sir?
87. 120 minus 33.
No, we are
Oh,
adding
we're
it.
adding.
Okay.
We are adding. So that will give us what? 153.
153.
Are you there now? Now, if 153 is the value, and we paid, I mean, 153 is the carrying amount, but the fair value is now at 150. The fair value is at 150. Do you understand? The fair value is at 150, but the carrying amount we have is 153. What's the difference between them? What's the difference between them?
It's 3.
3 million.
So 3 million.
3, 3,
That
3
means we
as a
have
loss.
a loss, right? That means we have a loss recognized on gaining the control. Loss recognized on gaining control of Tata. So we have 3 million naira loss. All right. Now this loss, where are we putting it? Where are we going to put this loss?
Is it not in our POL?
Where does the question say we should? In our notes, where did the note say we should put it? Where did the note say we should put it?
Papa. He said the financial statement of Papa have not yet been adjusted for the gain or loss arising on gaining control of Tata.
I don't understand, please.
Please,
No
I
true.
read note two.
We put it under group reserve.
Is that what the question says? Eh? The financial
According
statement of
to
Papa have not yet adjusted for the gain or loss arising on gaining control of Tata. Now I'm asking you, where are we putting it? Where are we recognizing it?
I think
Where?
it should be in the book of Papa.
No, of course it will be in the book of Papa now. In what account? Income statement or statement of financial position?
Income statement.
What part of the income statement? Revenue, expense, other comprehensive income.
If there's no existing revaluation, if there's existing revaluation reserve in the OCI, then we take it to the OCI. But if there's no, we take it to
Revaluation reserve will be
expense.
in balance sheet, not income statement. Don't forget that, sir.
I said if there is existing reserve that can accommodate the loss in our revaluation reserve, we take it to our revaluation reserve. But if otherwise, then we put it in our expense.
So no,
Going
yes,
to be in our POL.
ordinarily for this company, it should be in the OCI. All right, for revaluation loss. Revaluation loss is usually included in the OCI. Do you get me, sir?
Yes, sir.
So that is that. Any other question? Do you have anything else in this question? Anything else we need to compute? The rest of them are the normal consolidated financial statement. Now, this is what we should do. Let's have an assignment. Let's consolidate this financial statement, all right? And whatever we have, let's submit it before the next class. Can we do that?
Okay, sir.
Sorry?
Okay, sir. We will try.
Yes, we try.
All right. So please, again, let me note it to us. Now, the reason we are spending so much time like this is because, number one, I took 15 minutes out of our time. I took additional 15 minutes. Instead of 4:40, I started at 4:45. Instead of 4:30, I started at 4:35. But many of you did not join until 5:15, 5:20. And that made it up to about 45 minutes waste in our class. Now, we have added additional 1 hour or up to that 1 hour 45 minutes. The class is meant to be from 4:30 to 6:30. Do you
Well,
understand?
for me, I didn't know that we have class 4:30 today because we have case by 6. There was a message that there's a case study by 6 o'clock. So we're doing class by 4:30. I didn't think that we'll be able to maybe finish before the case class. So I was like waiting for a message to come in. I
I'm
just
not
said, let me
aware,
check. I discovered that we're already in class.
Okay, I'm not aware of the other timetable, but for this class, we are meeting on Friday at 6:30 to 8:30. Right? Is it 6:30 or 7
Okay.
o'clock? I think it's 7 o'clock, 7 to 9 on Friday. And then on
Okay.
on Sunday, 4:30 to 6:30. All right? This one that we are doing 7:40. Please, even last weekend, we spent up to about additional 1 hour. So please, let's endeavor to come on time. All right? That additional 45 minutes now, we could have used it for something else. All right, please. And I don't want a situation whereby once I say 4:30, I'm starting at that 4:30 immediately, even if I have only one student. Many of us will miss, and then at the end of the day,
Noted.
we will have to come back.
Noted, sir.
All right.
Sorry for the time wasted.
No. Just an advice for us. All right. All right. So see you all in our next class on Friday at 6:30 p.m. Good night, everyone.
All right, sir. Good night.